Today, we will talk about annualize, definition, formulas, and examples. Annualization means converting a short-term calculation or rate into an annual rate. This is often used to determine the annual rate of return on an investment, taking into account factors like compounding and reinvestment of interest and dividends. It helps to compare the performance of one security versus another. When a number is annualized, it's usually for rates of less than 1 year in duration, and it accounts for the effects of compounding if applicable. Common examples of when annualizing is used include forecasting financial performance of companies, calculating the annual cost of loans, and converting tax periods to an annual basis. Annualized return, similar to a run rate, predicts future financial performance of a company based on current financial information. It assumes that current conditions will continue to apply in the future. Loan products often express their annualized cost as an annual percentage rate, which accounts for all costs associated with the loan and converts them to an annual rate. This is important because flat finance fees for short-term loans can add up to a large annualized rate when compared to the original loan amount. Taxpayers annualize to convert a tax period of less than 1 year into an annual period, helping to establish an effective tax plan and manage any tax implications. This can be useful in estimating effective tax rates and budgeting quarterly taxes. Investments are often annualized to determine a rate of return over 12 months. For example, a stock's 1-month return would be multiplied by 12 months to calculate the annualized rate of return. Quarterly rates of return are also commonly annualized for comparative purposes. While annualizing can be useful, it's important to note that the annualized rate of return or forecast is not guaranteed and can change due to outside factors and market conditions. This can make the original forecast incorrect if there are fluctuations in stock prices, for example. Investors may annualize to forecast a stock's performance over the next 12 months, helping to better manage their risk and compare performance against other benchmarks. Investors annualize returns of less than 1 year, often using monthly or quarterly figures to predict future performance of stocks and analyze company metrics. Understanding annualization allows borrowers to better understand the annual costs associated with a loan, particularly through the use of the yearly rate of costs, expressed as a percentage of the amount borrowed. The primary drawback of annualizing a return is that it can change over time due to outside factors and market conditions, impacting yearly returns significantly. In conclusion, annualizing a number allows for the conversion of short-term figures into annual rates, helping to forecast financial performance, manage risk, compare performance, and establish an effective tax plan. However, it's important to remember that annualized figures can change over a 12-month period due to shifting conditions. Here are 4 key takeaways. 1. Annualizing can be used to forecast the financial performance of an asset, security, or a company for the next year. 2. To annualize a number, multiply the shorter-term rate of return by the number of periods that make up 1 year. 3. 1 month's return would be multiplied by 12 months while 1 quarter's return by 4 quarters. 4. An annualized rate of return or forecast is not guaranteed and can change due to outside factors and market conditions. Hope this would help. Thanks for watching.